Welcome back to Success with Steven. My name is Steven Smith, and today we're going to be talking about how to buy your first home with an FHA loan in 2024. Now, for this video, the reason why I'm making it is because when I do my one-on-one coachings, I would ask people usually what are they going to do once their credit is, repaired, it's excellent, no derogatory marks. What was going to be the next step? And there were some people who leaned on the side of they wanted to learn about business credit and they wanted to learn how they could leverage that to make money. But on the other side of the spectrum, many people wanted to buy their first home. And that's, really why I want to get into this. I did not get an FHA loan. So for this video, I want to preface that I have been pre-qualified for an FHA loan, and I did go through some of the steps in order to get a home. And I'm going to tell you in the end why I did not get my home yet, but what I plan on doing in the future. And this may or may not apply, to you, but each of these situations are going to be different. So I'm going to give some examples on here. I also want to give a disclaimer. If you're looking at these numbers, don't take these numbers as literal examples because there's too many variables to consider. You do want to get with a loan officer and you want to talk with them. You want to find a lender and you want to have them, come up with an estimate for your home. And you want to make sure that you talk to a professional when it comes to getting your mortgage loan. Okay. Now, the one thing I want to do is give you some information. So at the very least, one, you go prepared, because the fastest way for you to close on your home is going to be with information and having everything ready for that loan officer. So that loan officer can present that to the underwriter. So the job is easier for the underwriter. You got to think they get hundreds of applications a day. And if your loan officer is getting an application where a lot of things need to be reworked, that underwriter is going to kick that back and it's going to prolong the process. If you get everything prepared for them already, it's going to expedite this process. Also, having a good loan officer will expedite the process as well. If you have a loan officer where I will look at it like this. Go into a bank with the intention of interviewing your loan officer. Ask them some questions that maybe you already know the answer to. Maybe you got the answer from this video. Maybe you got the answer from, doing some additional research. But interview your loan officer and ask him questions. If the loan officer takes 30 minutes to answer a question that you could have answered in 2 minutes, maybe you want to get a different loan officer. Again, a good loan officer will be able to get this process done faster, and they probably have a good relationship with their underwriter. You need a marriage of both in order to expedite this process. But if you want to make sure that you do, your part, your share of the work, give them an application that they don't have to rework. So, everyone has to play a part. You have to play a part in presenting someone with an application that is going to be a smooth process, at least for what you need to do. And that way your loan officer can say, this is easy, we can get this done. And then when the underwriter gets it, because I'm sure that person's tired of going through so many applications, it's easier on them. Everyone has to do their fair share of lifting to make this process go smooth. All right. So with that said, let's get started. And we're going to see how we can buy our first home with an FHA loan in 2024, or if that's something that you still want to consider after getting some information. So let's start by talking about what is an FHA loan in the first place. A lot of people think that an FH loan is a first-time home buyer's loan, and that is actually not the case. FHA loans are just tools. Like conventional loans, like everything else, these are all just tools. Okay. They're not good or bad. How you use the tool will determine the result that you want. So the FHA loan is a Federal Housing Administration loan, and it's a home mortgage that is insured by the government and issued by a bank or other lenders that is approved by the agency. FHA loans require a minimum down payment that many conventional loans, and applicants may have a lower credit score than usually required. And again, this loan isn't just for first-time home buyers. This can qualify for, everyone. There is some information that we're going to go over when it comes to a FHA loan. Like, for example, you only have to put down 3.5% minimum if you have a 580 credit score or higher. If you have below a 580, a 579, then you have to put down 10% in order for you to qualify for the loan. And again, I'm giving you the bare minimum loan requirement. So keep in mind, if you have a 580 credit score and you meet the bare minimum, that doesn't necessarily mean that you are qualified. That's just the bare minimum to get you into the door to potentially get qualified. Okay? That doesn't guarantee anything. Some of these lenders, some of these banks, some of these unions, credit unions, they're requiring more now, even though FHA loans technically do not have a credit score requirement. They technically don't. Really, if it ranges from 500 to 579, you can do 10% down, 580, 3.5% down, bare minimum requirements. You do need to have this as your primary residence. You can't do this as an investment property. Now, you can do a owner occupied multi-unit with no more than 4 units. So if you were trying to maybe do this as an investment property, that's something that you could look into. It can be a multi-unit with no more than 4 units, but you still have to be the primary resident, and you have to be occupying that space, not just getting mail sent there. You have to live there. But that is another option to consider if you're looking for a real estate investment. All right. Some other information about FHA loans. This was presented in 1934 after the Great Depression. Okay, so it was just a loan to help people afford housing. All right. Now, how does it work? Again, if you have a credit score of at least 580, you can borrow up to 93.5% of the value of a home with the FHA loan as of 2024. And that means the required down payment is only 3.5%. If your credit score falls between 500 and 579, you can still get an FHA loan as long as you make a 10% down payment. But we have to, bear in mind, a 10% down payment in perspective. If the house was $500,000, you'd have to put down $50,000. And, most of us don't have $50,000 to just put down. So that 10% might not actually be feasible for most of us. Right. So that's not what we're trying to actually do. It's better if you can do 3.5% down. And then we're going to go into that. And then we're going to talk about exactly what that is going to entail. So, more credit score requirements. So lenders will take your 3 credit scores and use the middle score to qualify you for an FHA loan. So for example, if your Experian score is 680, your TransUnion score is 650, and your Equifax score is 750, your middle score would be 680. Of course, it's the one that is not the lowest, isn't the highest. It's right there in the middle. They will look at your payment history, how long your accounts have been open, if you have any collections or charge-offs. A lender can also do a rapid rescore. Now, a rapid rescore, I've gotten many different examples of this and how it's used, but I'm going to tell you the one from my experience. So, with a rapid rescore, lenders may not speak to you about this, but with a rapid rescore, a mortgage lender pays a fee to the credit reporting agencies to have a recent account change updated to a loan applicant's credit report in an expedited time frame. So, for example, if you have a credit card where your utilization is 30% and your loan officer tells you, hey, can you make a payment on this right now and drop this 30% or more utilization down to 10% or less. If you can pay it now, they can look at doing this thing called a rapid rescore, where they can get your score up in real time. So normally after you make the necessary payments to pay down or pay off an account as requested by your mortgage lender, it may take a full billing cycle or two for your creditors to process those payments and report the information to the credit reporting agencies. Only credit scores calculated after the updates have been made to your credit report will reflect the changes to your account. So this is another thing where regardless to how a mortgage lender does their rapid rescore, now that you're aware of this may not even be prevalent anymore. You may not care, because all you have to do is make sure that when you go, you pay all your balances down to 10% or less. That's another one of those things where I'm saying you want to come in prepared. This is an option that you do have, but it's no different from you just paying your credit cards down to 10% and then them updating for your billing cycle. This is just if you wanted to get it done faster, then this was something that they do have an option to do. But because mortgage loans are oftentimes sensitive, a mortgage lender may prefer to pay that fee to have an applicant's payment information updated quickly. And the lender has to submit proof of recent payments, updates such as paying off or paying down debts to the credit reporting agency, so new information can be updated, and that helps expedite the lender's mortgage approval process. Now, once the credit report is updated, the lender can request a new score that reflects updates, and ideally it results in a higher score. And you usually see these changes take place in 2 to 3 days. Now, even with you being aware of what this is, from my understanding, this isn't something you can request. It's something that needs to be offered to you. But in actuality, I have seen situations where people have just paid their cards down, and then they contacted credit bureaus to see if the credit bureaus could update their score for free. So, you could try either or, but the main point being, you're aware that when you go to get an FHA loan, if you have high utilization or you have debt or you have collections or you have charge-offs, you're aware now that they're going to ask you to pay it. So just off the bat, we have plenty of content for credit repair, everything like that. You can check out all that content. But, if you have that on your credit report, you kind of are already aware that they're going to ask you to pay that now. So just, be prepared to already do that. And again, make it easier on the loan officer so he can make it easier on the underwriter, so this can go as smooth as possible. Okay, so this is other FHA loan requirements that we just went over, but we're just going to touch on again very briefly. So your history of paying debt. A lender will look at your work history as well as your last 2 years of payment history on your credit report. We have videos on getting late payments removed. So you definitely want to make sure that if your late payments are in the last 2 years, last 24 months, you've taken care of them. If they're older than 2 years, they're not going to be as impactful in this process. So if the late payments are older than 2 years, it's okay. If it's in the last 24 months, you want to get those updated. Proof of steady income. So mortgages must be repaid, and FHA approved lenders, they want assurance that applicants can achieve this. So the key to determining if the borrower can make good payments is evidence of recent employment and that you've been at that employer for a long period of time. Now, for this video, I'm not going to be talking about self-employed people. I'm a self-employed person, so trust, I understand. But for a majority of the people watching this video, I'm sure you're W-2 employees, you work for someone. So I want to touch on that. If I get enough request for self-employment and how that works for us, I can touch on that in a separate video. But I want to focus on what the consensus is going to be right now. A lot of you guys are W-2 employees. Sufficient income. So your mortgage payment, HOA fees, property taxes, mortgage insurance, and homeowners insurance, it should ideally be less than 31% of your gross income. And banks call this the front end ratio. There's also the back end ratio, and 31% is actually fairly low. And you're going to see me talk about back end ratio and front end ratio, but I'm going to be throwing around a lot of different numbers. Again, don't take this as a literal example because it's so hard for me to say what it's going to be. It all depends on one, the lender, and depends on your credit score. Sometimes with your credit score, if it's higher, then your back end ratio can be a little bit higher. You know, if your credit score is lower, then that back end and that front end ratio has to be a little bit lower. 31% is an idealistic number. You probably won't see that very often, but when I'm talking about things, I want to say it with the highest expectations, even though that may not be the case for most of us. So just know that, 31% of your gross income probably isn't what most people are doing, but I like to give people the most responsible numbers, and I'm going to talk about that later. We're going to touch on what's responsible for our debt to income ratio. Okay. Now, more FHA loan requirements. Now, history of paying debts. Once again, people who fall behind on federal student loan payments or income tax payments will be rejected. Okay. I'm not saying that's the end all be all, but the thing is, if you have income taxes that need to be paid, you want to take care of your taxes immediately. If you're falling behind on federal student loan payments, you want to take care of those. All right. Now, you can agree to a satisfactory repayment plan. So you'll want to take care of all of this stuff before you look at getting an FHA loan. So a history of bankruptcy or foreclosure can be problematic too. Typically, to qualify for an FHA loan or any type of mortgage loan for that matter, at least 2 years must have passed since the borrower experienced bankruptcy or foreclosure. So just because you have a bankruptcy does not mean that you can't qualify for an FHA loan. It will be a harder uphill battle for you, but at least you want it to be 2 years since that bankruptcy, at least 2 years. That doesn't completely disqualify you from the loan. It's just going to make it a tougher battle for you. Okay. You want to, if you have foreclosure or if you have bankruptcy, you want to establish good credit for at least 2 years and show that you have your financial affairs in order. You have to come the most prepared in this situation. There are exceptions that can be made for borrowers who have experienced extenuating circumstances, such as serious illness. I think a lot of us have some extenuating circumstances from COVID. I think a lot of us had a lot of financial strain during that time period. That's when a lot of, debt that I had started to go into collection. I started getting charge-offs. It all happened during COVID. It happened to a lot of us. We all know those circumstances, and they were extenuating for a lot of us. So, we can definitely use that. Also for student loans, there was something called the CARES Act. At the time, the CARES Act was for lenders and creditors. Let me be correct. At the time, they were not supposed to be reporting late payments. Student loans, they were deferred for a period of time. So don't forget to also include that, if those circumstances were the case at the time, things happen and we can explain those things. We just want to make sure that when we go, we have our story together. We have all of our finances in order. And then we'll go into some more things that we need. Income can be documented by tax returns and a current year-to-date balance sheet. The balance sheet for current year-to-date really will apply to self-employed individuals. Profit and loss statement as well. That's going to apply to individuals who are self-employed. And if you have been self-employed for less than 2 years, but more than 1 year, you may still qualify if you have a solid work and income history in the same or related occupation for the 2 years before becoming self-employed. Now, what do I mean by that? For example, my previous work history was in finance and it was also in sales. So if I can somehow correlate 2 years prior that I was working in this same occupation and I can make it make sense, then I can say, well, here are the 2 years of my work history where I was employed for, W-2. I was employed by this company. And then I transitioned over to this to become self-employed, but I can make a connection between those two things. Potentially that can be used to show solid work history because I was in the same field. I was in the same occupation. Now, sufficient income. We talked about front end and back end ratio a little bit. Your back end ratio, which consists of your mortgage payment and all other monthly consumer debts, should be less than 43% of your gross income. Now, remember the previous slide, I said 31% if we're being, ideal. Back end ratio, if we're being honest, can go up to 57% in 2024, I believe. Back end can be 57%. And I'm going to touch on debt to income ratio soon so that we have a better understanding of that, because I think that's one of the most important things that we have to talk about when we're talking about getting qualified for an FHA loan in 2024. Before we go further into FHA loan and requirements, I want to tell you the difference between an FHA loan and a conventional loan. Now, I won't be able to cover exactly everything in this video, so if I missed anything, you could let me know in the comments. And if you want me to go into further detail about things, then let me know. Because I know this is going to be a lot of information, and I want to try to pack this with as much value as possible. But I know it's not, it probably won't be realistic for me to get everything all in one video, but I'll try to get as much as I possibly can. So if I missed anything, please excuse me. I can always go back and I can always add more or talk about one particular thing in more depth for you. Okay. So now FHA loan versus conventional loans. For the minimum credit score, again, I told you that technically, if we look at the FHA guidelines, I guess technically there isn't a minimum score requirement, but you should at least have a 500 credit score. Again, if you have a 500 credit score, you're going to have to, between 500 and 579, you also have a down payment of 10%, which is $500,000. If you're looking at $500,000, that is $50,000. That doesn't include closing costs or any of the other fees that we're going to talk about. So trust me when I say it gets pricey for, you could be potentially looking at, with 10% down at that, you might be looking at paying like $60,000 to $70,000. So, I don't know if that's really feasible for most people with a 500 credit score to 579, especially with today's interest rates. With conventional loans, you typically want to have a 620, but that can vary by lender. And that's the reason why you can't take any of these numbers that I give you literal. They're based on your county. They're based on state. A lot of stuff is, there's so many different factors. It's based on lender, it changes a lot. The minimum down payment for an FHA loan, this doesn't change. It's 3.5% with a credit score of 580 and beyond, 10% for a credit score of 500 to 579. A conventional loan can be between 3% to 20%. Okay. Loan terms for FHA loans are 15 to 30 years. Conventional loan terms, you usually see 8 to 30 years. Mortgage insurance, and we're going to talk about this. Up front, you have MIP, plus you have annual MIP for either 11 years or the life of the loan, depending on the LTV, length of the loan, okay? Some people look at you're going to have a couple mortgage insurances that you have to pay with FHA loans. And a lot of people don't really like those insurances. You're going to have the MIP, there's PMI, and it can get very expensive. That's, I would say, maybe one of the cons of an FHA loan. But the pro is that you could get, for example, a $500,000 loan where you only have to put down 3.5% plus your closing cost and fees. So that's the upside. You got to, it's give and take. All right. With the conventional loan, you may not have mortgage insurance. Well, you actually won't have insurance with a down payment of 20% or more. Or after the loan is paid down to 78%, then you also, won't have that. So with conventional loans, if you can put more money down, it does give you a break on mortgage insurances. Now, mortgage insurance premium, no matter what your credit score is, it doesn't matter if you have a 500 credit score or you have an 850 credit score, you will have an upfront 1.75% fee that you need to pay. That's going to be a 1.75% of the loan. So you're going to have to pay 1.75% of that $400,000 house, $500,000 house, plus an annual 0.15% to 0.75% on an FHA loan. When you have a conventional loan, you're going to have a PMI of 0.2% to 2% of the loan amount per year. There is no PMI on a 20% or more down payment. That is one of the advantages of a conventional loan. But again, I'm not saying one of these is better than the other. This is dependent upon your situation. There are situations where an FHA loan could work. There are situations where a conventional loan might be better. It depends on your situation. Again, it's not to say what's good and what's bad. These things are just tools. They're just tools that we use. Okay, I'm going to get more into mortgage insurance and mortgage insurance premiums later. I just want you to know the difference between what you're going to have for an FHA loan, what you're going to have for a conventional loan. Now, down payment gifts, 100% of down payment can be a gift. We're going to talk about that later too. Some or all of the down payment can be a gift depending on the lender. So that's the difference between that and a conventional loan. Down payment assistance, you can have that with an FHA loan. With a conventional loan, you can't use down payment assistance. Okay. Now, FHA mortgage insurance premium. So an FHA loan requires you to pay two types of mortgage insurance premiums, MIPs. You're going to pay an upfront MIP and an annual MIP, which is paid monthly. The upfront MIP is equal to 1.75% of the base loan amount. Now, here's the good thing about the upfront MIP. You can actually work that into your loan. Okay? So when you have a loan of $500,000, you're going to have your down payment, right? Your down payment will deduct from the 500,000, but then the 1.75% is going to be added into that. Most people don't pay that. They just add it into their loan, their FHA loan. Okay. So you can either pay the upfront MIP at the time of closing, or it can be rolled into the loan. So for example, if you're issued a home loan of $350,000, you'll pay an upfront MIP of 1.75% times $350,000. That's going to be $6,125. Okay. These payments are deposited into an escrow account that the U.S. Treasury Department manages. If you end up defaulting on your loan, the funds will go towards the mortgage repayment. Despite its name, borrowers make annual MIP payments every month. All right. With these payments ranging from 0.15% to 0.75% annually off the base loan amount. The payment amount will differ depending on the loan amount, the length of the loan, and the original loan to value ratio. That's the LTV. The LTV is your loan to value ratio. So it's hard to give you exact numbers on this, but I'm just going to try to give you examples. And again, this is the kind of thing where I want you to have an idea of what you're going to be paying or what you're going to be looking to pay. But these are things where, as long as you maybe know a little bit of this, you can kind of test what your loan officer knows by just asking them a couple of questions. So let's assume that you have an annual MIP of 0.55%. In that case, a $350,000 loan would result in an annual MIP payment of 0.55% times $350,000. That would be $1,925 or $160.42 monthly. Now stay with me. These monthly premiums are paid in addition to the one-time upfront MIP payment. You will make annual MIP payments for either 11 years or the life of your loan. Now, here's something else. If you pay a 10% down payment after 11 years, you no longer have to pay that MIP payment. However, if you don't put down 10% for your FHA loan, you will have that MIP payment for the life of your loan. So keep that in mind. You're going to have to pay that $160.42 for the life of your loan, which, if you looking, let's think about it like this. The $160.42, if you're paying that per year total, it's $1,925. Multiply that times 30 if you have a 30-year loan. You're going to pay $57,751.20 additional for the life of your loan. And that's why some people don't like FHA loans, because of things like that. But again, I'm not saying that's bad. It depends on your situation, because again, think about it like this. If you didn't pay that, remember what I said, you'd have to put down 10%, $50,000 plus everything else, plus closing cost, with all the fees that are associated with that. We're going to talk about that as well. So pick your poison. Do you want to put down the 10%? If you do, potentially the life of your loan, it could save you that $57,751.20. But maybe you were going to refinance this loan. Maybe you were going to change it later. Maybe that was your intention. With the money that you saved by only putting down 3.5%, maybe you were going to invest that money. Maybe it makes sense after 30 years. Again, these are just tools. All of this, everything we're looking at is situational depending on you. This can be a good thing or a bad thing. It just depends on how you use it. Again, they're just tools. So now that we have an idea of what we're looking at when it comes to MIPs, and we know that you're going to pay two types of mortgage insurances when you have an FHA loan, let's talk about the advantages and the disadvantages. So FHA loans are often the best source of a mortgage for certain borrowers that are unable to obtain financing through private lenders. Thus, you may qualify for an FHA loan with a lower credit score and or a greater amount of debt. Having a higher debt to income ratio, basically. However, because FHA borrowers are often riskier or potentially deemed riskier, FHA loans usually come with a somewhat higher interest rate, and they require MIPs paid both upfront and monthly. Remember I said that that's that $6,000 that I talked about, where you can, add that into your loan. FHA loans can only be used for your primary residence and come with certain borrowing limits. So pros. You're available to borrow with a lower credit score. That's a pro. A lower down payment. That's a pro. It's a federally backed loan. These are all pros. Cons, it requires you to have these MIP payments both paid upfront and monthly. In the long run, depending on what you do, it might cost a lot more. It cannot be used for second homes or investment properties. Now, again, I told you that if you have a multi-unit with up to 4 units and you're still the primary resident, you can work that in there. But for the most part, this is not for investment properties. It's not for investment properties. And I'm not talking about getting mail there. This is not an investment property. If you want an investment property, look at a conventional loan. Higher interest rates can come with this as well, and not all properties qualify. All right. Now, I want to get back to talking about debt to income ratio. And this is part of the reason why, even though I was pre-qualified, I couldn't make it make sense for me personally, right? So eligibility means nothing if you can't afford to make mortgage payments. Lenders qualify you off your gross income. That does not include your groceries, your childcare, your phone bill, etc. You don't want to be home rich and cash poor. So if you make $100,000 per year, a lender will look at your gross income and the minimum payments on your credit report. Once that's totaled, that is called debt to income ratio. So I'm going to talk about that, but I just want to speak to you very realistically for a second. When your mortgage lender is trying to get you approved, some people just want to meet quotas and just get you approved for a home, and they may not have your best interest at heart. You have to be responsible for yourself. And even if you get qualified for something, it doesn't mean that you can technically afford it. So I'm going to give you an example where we talk about this. But when a mortgage lender looks at your debt, all they look at is what's on your credit report. That doesn't include your phone bill. That doesn't include your child care. That doesn't include the gas that you put into your car. That doesn't include you going out just to have fun. So basically, when people are looking at you getting this mortgage loan, they're not looking at any of your discretionary expenses. They're looking at it like you're a robot. Like all you're doing is paying these bills on your credit report. But what about my utilities? What about, when I just want to go hang out with my friends? What about when I go get a restaurant? Like all of that stuff is not included. So you may have like 20% of what you make every month may go to discretionary income. Maybe you want to buy a new outfit. Maybe you get your hair done. I go to the barbershop. You know what I'm saying? It doesn't include that. And we're not robots. We're human beings. You want to make sure that when you're doing your monthly budget, remember I had a monthly budget calculator. Your monthly budget should let you know whether or not you can afford to do this. So even if they qualify you for a $500,000 home, it doesn't mean that you should get it, because your monthly expenses, your monthly budget. They're just talking about your debt to income ratio, but your monthly budget. So you want to be responsible because, you want to make sure you're looking out for the best interest of yourself and your family. Okay. Now, how to calculate debt to income ratio. I'm going to use a solid number as an example. So I'm going to use $120,000 because that's $10,000 a month. It's a very easy, solid number. So a lender will look at your gross income and the minimum payments on your credit report. Remember, they're not looking at your balances. They're only looking at the minimum payments. So if you can have a $30,000 car with a $300 car note, they will only look at that $300. So if your minimum payments come up to, let's say, $1,000 per month. So they're saying like, okay, that's $1,000 worth of your minimum payment on your credit card is $25. This one is maybe $100. Your car note's $300. They're only going to look at what's on your credit report. Okay. So if those minimum payments come up to $1,000 per month and you're buying a $400,000 home, that might be a $3,000 mortgage payment. All right. Now you have the $3,000 plus your $1,000 as debt. That equals $4,000. Right. If you divide 4,000 by 10,000, you get 0.40, which is 40%. That is a 40% debt to income ratio. A debt to income ratio of 43% or less can offer you the most options when applying for a mortgage. Okay. That's going to offer you probably the best options, but this number can go this number that we're looking at is the front end ratio. That can probably go as high as 47%. But then there's the other one, the back end ratio is going to be a little bit different. 57% is usually the max, but this can vary by lender. So when you're looking at a 40% debt to income, again, it's not including your groceries, your child care, your gas that you're driving your car around. It's not including your phone bill. It's not including your car insurance. Your 40% is really like 70%, right? So 70% of your debt to income, you want to be careful because you could be one payment away from a foreclosure. So just keep that in mind, that when they're calculating this, they're not including what you're paying every month. They're only including what they see on the credit report. And that's not everything. And we know that. And we're not robots, right? So I'm going to give another example of front end and back end debt to income ratio. So front end ratios. Front end ratios are going to be your monthly expenses plus your gross income. That's pre-tax. Everything after tax is your net income. All right. Net income is what you have after taxes. Gross income is what you have before taxes. All right. So they're going to look at your gross income, and that's going to be your front end debt to income ratio. Now, when they add your monthly expenses with your gross income, that's the back end debt to income ratio. Let me give you an example. So if you make $120,000 a year, divide that by 12, we know that's $10,000, right? If we multiply 0.43%, I showed you on the last slide how to calculate your debt to income ratio for back end. If you get 43%, that means you can have a mortgage of $4,300, and they're going to say, oh, you qualify. That's only 43% debt to income ratio. You qualify for front end. Okay. Let's say you need a little bit more. They'll take that same 120,000, they'll divide it by 12. That's $10,000 times, let's say it goes up to, because if your credit is good, they'll let you push this up for back end. Let's say it's 0.57, which is 57%. You can qualify for a 5,700 back end ratio, because they're going to say, oh, it's 57%. We're pushing it, but your credit score is good, so you can handle it, right? If we only make $10,000 a month, and all we're left with and we're already going to lose 5,700. I mean, that doesn't leave us with much. That means we have $4,300 left. That's it. That's all we have. What happens after you pay all of your bills, your utility bills, your grocery bills, everything? You might only have $500 left of disposable income. You can't afford that house. You can't afford it. You can't afford it. And that's why at the beginning, remember I showed you an example with a 31% debt to income ratio. Why? Because now you're looking at a $3,100 mortgage potentially. If you make $10,000 a month minus that $3,100, that's more feasible. That's a lot more feasible. You can kind of work with that. You can't work with this. At least, So that's the reason why I just wanted to show you, like, even when a lender does that, when you talk to the loan officer and they're adding all this in there, ask them about your front end and your back end ratio and ask them what the percentage is. Take that percent home, get out your monthly budget calculator. I have, it's on my successwithstevensmith.com. Check out that budget calculator. I spend a lot of time making that. And add your mortgage in. Add it in there and see. It's going to tell you how much money you have left over. Add it in. And if you have less than, I would say, if you have less than 10% of your monthly income, I don't think that's a good idea. I think you should reconsider, which is something I had to reconsider myself with interest rates being so high. But interest rates, they fluctuate. If you go back to 2020 and 2021, they had some interest rates as low as 3.5%, half of what they are now, which is why, for me personally, even getting pre-approved, I had to decide what's important to me And what am I really being realistic and being honest with myself? I would rather wait for houses to come down, because if you look at the cost of homes, they've exponentially increased since 2019. It's crazy what they've gone up to. There were some houses that are worth 500,000 were like 280,000, some less than that. You know what my mortgage could have been if it was 280,000? That same, I'm not getting more house. Now it's 500,000. So I'm just, it's things to consider. Please think about that when you're looking at your FHA loan. Another thing I want to go over very briefly are non-occupying co-borrowers, and are they allowed? So what I'm saying is, some of you may be asking, well, what if I have a spouse? What if I have a girlfriend? What if I have a wife? A co-borrower, and I'm making definite note of non-occupying co-borrowers, people who can co-sign your loan but don't live there. So the short answer is yes. You can have a co-borrower on an FHA loan who does not live in the home as a primary resident. One borrower will have to live in the home. However, they don't technically, one has to live there, the other one doesn't. But that would be a lot of liability for a person who doesn't live with you. You know what I mean? Because you can technically use their income as well, but if they're not going to be paying bills in that house, it doesn't really make sense, right? And also, looking at these numbers, keep in mind, I'm only talking about an individual. So if you and your spouse make $100,000 each, and you're both going to be on this loan, it's $200,000, and that can be different. That's a different story now with the two of you doing that. Okay, it may be affordable. If you're an individual, then you want to take a look at that. So FHA loans, we know that they're government backed, and these loans they often come with sometimes higher interest rates, sometimes lower. Again, it depends on your credit score. But they come with limitations regarding how they can be used. And often when people talk about non-occupant borrowers, they're talking about people taking out investment property loans so they can buy a property they themselves won't live in. So even when you're looking at non-occupying co-borrowers, you usually see those on conventional loans. Borrowers cannot use an FHA loan to finance the purchase of an investment or vacation property. So I just want to make that clear. The residency requirements are not unique among non-conforming loans. FHA loans offer a unique twist by allowing non-occupant co-borrowers. With the help of non-occupying co-borrowers, the qualification process for an FHA loan, it can be much easier. So if you wanted to use a family member, grandma, grandpa, someone else who was going to co-sign this loan without actually living on that property or actually being there, just know that you can. That is something that you can do. I know it's a question that might come up. And of course, if it's somebody who's going to occupy the space with you as well, then even better, because more than likely if they're occupying the space, they're going 50-50 on the bills. So the more people that we have with income to put towards that home, the more feasible that it becomes. So I don't want to make this all like a doom and gloom, because again, two people who are making $100,000 each now, or $120,000 a piece is $240,000 total. Now that debt to income ratio starts to look a lot better when you're looking at two people. So that can actually work. Or if you have a co-borrower, now again, if you have a co-borrower, it may help you qualify, but if they're not going to actually be contributing to monthly bills, I don't think it makes your situation any better. And again, you normally see this with investment properties, but if you're not, this is an FHA loan, it can't be an investment property to a degree. So I don't think that that's something that you should be looking at doing if you're the primary resident there. Now, if this is a conventional loan, that's a different video for a different time. But I just want to address this as someone may want to consider doing that in order to get a home, and just, be responsible. Now, let's talk about FHA mortgage limits. Now, these limits can vary by state. We're going to go over to HUD.gov. I'll put a link in the description because that's not the exact website. But let's take a look at what the mortgage limits are for our state. All right, so I am on the FHA Mortgage Limits website. So this page allows you to look up FHA or GSE mortgage limits for one or more area and list them by state, county, or your city that you live in. All right, and the results will vary. The median sale price values, they vary by jurisdiction, and those median prices are estimates. All right, to determine loan limits. So let's take a look. I'm going to look at my state. I am in Nevada, and our county is Clark County. Now, you want to make sure that you're paying attention to your year limit. We're in 2024. And I'm just going to click send. Now, for my county, it's Las Vegas, Henderson, and Paradise, Nevada. All right. So for the state of Nevada, a one family home, $498,257 is the mortgage limit. $637,950 for a two family home. For a three family home, $771,125. For a four family home, $958,350. The median sale price is $430,000. That's the average sales price. And this was last revised on January 1st, 2024. I recommend that you actually take a look at this and you look at it for where you live at and look at all of the limits. And then there's also the basic standard mortgage limits for FHA insured loans. They have that here as well, for, the highest being almost $1 million home. So if you have if you're looking for a four family home unit, it can be almost up to $1 million. All right. I'm going to put the link in the description. You can kind of play around with that and you can take a look at the limits for your area, because again, it is going to vary by your state and that county that you live in. Okay. All right. We're going to talk about the closing cost. So FHA closing costs are fees that are charged when you take out an FHA loan. You'll pay many of the same types of fees, and they're going to be charged on other home loan types, including credit reporting fees. There's underwriting costs and home appraisal fees. A down payment is considered to be a totally separate closing fee. So I'm going to throw you some numbers just to give you an idea of what you're looking at. Now, closing cost fees are not included with your down payment fee. I want to make that very, very clear. Neither counts towards the other. And in order to qualify for an FHA loan, you'll still need to put down at least 3.5%. And some examples are, again, upfront mortgage insurance premium, annual mortgage insurance premium, FHA appraisal cost. Okay. Standard closing fee costs. There is a origination fee. There is a credit report fee, flood determination or certification fee, flood monitoring fee, tax monitoring fee, lender's title insurance. There's a discount points fee, escrow account fee, prepaid fees, transfer taxes. So all but 13 U.S. states charge a transfer taxes if ownership is transferred from one homeowner to another. State laws may set rules on who can pay them, and in some cases you may be exempt from them. However, they can make up a big chunk of your total closing cost on a mortgage. So again, it's hard to cover everything in one video. You want to take into account that a lot of these things are contingent upon where you live, how much money you make, your credit score, so many variables, right? So it's hard to really put a pulse on what is going to happen to you. But these are an idea of standard closing fees that you're probably going to see. And I'm going to give you an example of what closing costs looks like. All right. So how much will I pay for closing costs? You typically pay between 2 to 6% of your loan amount towards closing cost on any mortgage loan, depending on your loan amount. And the average home price for FHA borrowers was $330,200 at the end of 2022. You saw the median home buying price in 2024 is now right around $430,000. So if you're looking at 6% of $430,000, let's just take a look at that. You're looking at about $25,800 when it comes to closing cost. So that can be between $6,604. That was $19,812. That was as of 2022. For 2024, I would say it could be between probably, let's round it up to about $9,000 to around $26,000 that you're going to pay for your down payment and for closing cost. Okay. And I'm going to give you an example of that. And I'll give you a breakdown. Now, here are some options to lower your closing cost or different ways that you can maybe roll some money in. So there are options available for you, although if you can't afford closing costs altogether, there are ways that you can reduce the amount that you pay out of pocket. You can ask for a gift. A relative, friend, employer, charity, or local government agency providing closing cost assistance for first-time buyers can gift you money towards your FHA closing cost. Now, this is something that if you're looking for a closing cost assistance program, you're going to want to look that up. But that is an option for you. Now, you must document the proof of the gift funds, and the donor is required to sign a gift letter. They have to sign it. Reason being, if you can't gift yourself money, okay? Just get that idea out of your head. Reason being, they don't want this to compromise they don't want to take away from your gross income. Because if you gift yourself money, technically, if that money's coming out of your gross income, then they have to rework everything. So you can ask for a gift, but the gift has to come from someone else, and they have to also have a gift letter. And you got to understand that an underwriter will go through all of this, and they will verify this information. They will verify it. Okay. So apply for closing cost assistance. Banks and housing finance agencies in your area may offer FHA closing cost assistance. There may be income limits and other restrictions, so you want to read up on the fine print before you apply. You got to read up on this, guys. Ask the seller to pay them. Now, you can ask a seller up to 6% of the sales price of the home. They can pay them, and the credit can be used to pay those fees, those upfront mortgage fees. Okay. You can ask the seller to do it. Now, that's a situation where I would say maybe it depends on how anxious the seller is to, get rid of that home. If in the end they're selling the house for so much more than what they actually paid for it, that for them it makes sense to help you close, it just can vary. Get a lender credit. Your lender may be willing to cover some or all of your closing costs, but in return, they'll charge you a higher interest rate. I don't really see that as making much sense, depending, again, it's situational. These are all just tools, and these are just options. Roll the cost into your loan. And yes, closing costs can be included into your loan amount if the lender offers a no closing cost loan. These are, I would say, rare, but you can find them. These are all just different options if you think the closing cost is too high for that FHA loan. Now, I want to give you a loan sample estimate. For this, we're going to go over to the consumer finance website. You guys know I use this a lot, and we're going to take a look at this estimate. Now, I'm going to link this in the description just because I want you to be able to take a look at this loan estimate, and I want you to make sure that when you're getting this, you're able to look at it. So one thing when you're looking for a home, you want to get pre-approved first. Why? You want to know what you qualify for. You don't want to waste your realtor's time. And most realtors are going to ask you to get pre-approved regardless. Now, if you get a loan estimate for a house that you did find, an estimate is just an estimate. It can change. These numbers are not final. A lot of things can change these numbers. Sometimes they change them. They send you emails and ask you to sign. You may sign something and not know that you're paying $10,000 more than what it was. You want to pay attention to all of this. So let's go over it. So loan terms. It lets you know that it's fixed. And this example is talking about a conventional loan. I want to point out one thing. In your FHA loan, the only amount that's fixed in your loan is the principal amount and your interest rate. Everything else in your loan can change. For example, if your property goes up in value, your property tax insurance can increase. A lot of other things can increase and be subject to change. All right. So when you're looking at this, these parts that are in orange, these are things that are fixed. Your monthly principal and interest rate is fixed unless you're refinancing. Your loan amount is fixed. It can't be changed. Okay. Everything else in your loan can change over time depending on what's going on. So you want to make sure that your name is right. You want to look at the long term. You want to look at your loan type and make sure that it is, that it's right. Rate lock before closing your interest rate. Points and lenders credits can change. So that's letting you know right here, when you're looking at your loan estimate, this can change. This right here is not locked. Before closing, your interest rate points and lender credits can change unless you lock the interest rate in. All other estimated closing costs expire. Okay. So once you buy the house, your principal won't change. Your interest rate can't change. When you're looking at the estimate, it's subject to change. Keep that in mind. So let's take a look at the projected payment calculator here. This is your principal and interest that you're looking at. And you're looking at for the first 1 to 7 years, and you're looking at the next 8 to 30. Estimated escrow. So there might be other charges related to home ownership, such as, remember, property taxes and homeowners insurance that are bundled in your monthly payment. This portion of your payment will come from your escrow account. Estimated total monthly payment. So it's showing you that in the first 1 to 7 years, it's $1,050. From years 8 to 30, it's $968. So this total payment you will make each month, including your mortgage, insurance, and escrow if applicable. And then make sure that you're comfortable with spending this much on housing each month. Okay. Now right here, estimated taxes, insurance, and assessments. $206 is the monthly estimate. And that estimate includes your property taxes and your home owner's insurance. And this is currently in escrow. Now look at the closing cost, $8,054. That includes $5,672 in loan cost plus $2,382 in other cost, right? So again, a lot of this stuff is subject to change. Estimated cash to close, they're showing you for your estimated closing costs, it could be $16,000. All right. So everything that you see right here in loan cost in section A, this is what the bank controls. Your lender, the bank, they control this. They control the origination charges. They control application fee. They control the underwriting fee. They control this percent for the loan amount. That's what they control. They don't control anything else in these other sections. From B and on, it's not the lender. Your appraisal fee, your credit reporting fee, your flood determination fee, all of those tax monitoring fees, tax status research fee, all of this is not controlled by the lender. And you could take a look at this example and see all the other fees that are included: your survey fee, your pest inspection fee, your insurance binder, your lender's title policy, your settlement agent fee, your title search, all of that stuff. All right. So when we're talking about closing costs, look at all the different fees that you have to consider: your homeowner's insurance, your mortgage insurance, your property taxes, and then the insurance premiums, right? These all get bundled in. So when we first started, we were looking at, all of these fees included, $1,802. Once we got to the very, 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 very end, our total closing cost was $8,054. Look at how fast that changed. Total closing costs, $8,054. So now we have our down payments, funds from borrower, right? Total closing cost, total down payment, $18,000 that we're looking at here. Estimated cash to close, $16,054. So the estimated cash to close is what you were expecting. So your estimated cash to close is the estimated amount of money you will have to bring to closing. This section shows how the estimated cash to close was calculated. Your estimated cash to close includes your down payment and closing costs minus any deposits you have already paid to the seller, any amount the seller has agreed to pay towards your closing costs, seller credits, and other adjustments. If the estimated cash to close isn't what you were expecting, ask the lender to explain why. You will typically need a cashier's check or a wire transfer for this amount at closing. The lender you choose will also need to document the source of the funds you bring to closing. Ask the lender about what documents you will need. Okay? So again, even if you think you have the down payment, you're not just looking at 3.5% of the total loan cost or the total home cost. You're looking at all these other additional fees, down payment plus closing cost. All right. And I'll give you this sheet for example, so you can take a look and then even look at the comparisons. So use these to measure your loans and compare them to other loans. So in 5 years, $56,582. That's the total you will have paid in principal, interest, mortgage insurance, and loan costs. But check this out. Only $15,773 you will have paid off of the principal. The principal is what you actually are paying towards the home. In 5 years, you would have paid $56,582, but what goes towards the principal is only $15,773. Now that's with a APR of 4.274% in this example, and then the total interest percent, or the total interest percentage, is 69.45%. That is the total amount of interest that you will pay over the long term as a percentage of your loan amount. So as you can see, it gets very, 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 very expensive. Very expensive when you're looking at what you're going to pay in total for that loan over a 30-year term for this example. And this is why I wanted to show you this. You want to make sure that you have an idea that you have the closing cost in the bank. They're going to ask you for that. They're probably going to just, ask you to have that in your bank for a couple of statements. You're also going to want to have the down payment. Take a look at programs for closing cost assistance. I recommend that because you definitely want to make sure that you've exhausted all options to make sure that you're paying as little as possible out of your own pocket. Okay. Now that we've gone through an FHA loan and we've gone through what that is, we've broken down the cost that you can expect when you have an FHA loan. We talked about eligibility versus affordability, and what we need to make sure that we look out for to make sure that we can actually afford these home loans. I want to do a quick overview of basically the process that we're going to go through when we're buying a home in 2024. One, find a lender. Find the right lender, guys. Finding the right lender is very, very important. Finding a lender that is willing to offer an FHA loan service is the first order of business. The Federal Housing Administration ensures lender repayment of loans made to homeowners. Financial institutions, mortgage brokers, credit unions, and internet loan platforms handle FHA loan processing steps. Mortgage insurance premiums are an extra cost. Of course, we know that homeowners must include in their budget. Payments for mortgage insurances are proportional to the loan duration and the principal loan amount. So take your time when you're looking at a lender. Pick one that has a history of being really good with first-time home buyers and that are willing to work with you in order to give you the assistance that you need. Read reviews, do your research. Once you found a lender, you want to submit the essential documents. Now, this is where I was saying at the beginning, you have to make sure you do your due diligence. So the Federal Housing Administration, FHA, requires applicants to document their work and income to be considered for a loan. Using this information, your lender can tell you whether you meet their requirements and calculate what interest rates and loan durations to offer you. So recent federal and state tax returns are something that you can use. Copies of W-2s, wage and tax forms for the previous 2 years. Recent bank statement, other asset financial statements, recent pay slips, a copy of social security or disability payments or evidence of income, name and location of your 2 most recent employers, and the updated profit and loss statements if you are self-employed. Okay? Find a lender. Make sure that when you find a lender that you have all of your documents prepared. All right. You want to make sure that you have an idea of the house that you're looking for, at least price wise. And then you want to make sure that you have an idea of what the closing cost is and what the down payment is. And you want to have that amount in your bank. You want to have that amount. And then you want to have one of these documents to show that you have steady income that you can make the mortgage payment that you expect to make. Step 3, fill out the application, get pre-approved. So online applications are accepted by a majority of lenders, but some also allow you to speak with a mortgage lender by phone or mail to finish the process. Although being pre-approved for an FHA loan processing steps is not required, it is strongly suggested. Reason being, if you're working with a realtor, most realtors won't even really want to start this process unless you're pre-approved. All right? Because without a pre-approval, we don't even know if looking at houses even makes sense yet. If you're not pre-approved and we're looking at homes, what are we looking for without a pre-approval? All right? So pre-approval is a stage where a lender evaluates your finances to determine if you qualify for the loan, and if so, the amount they would grant you. Okay, we talked about that. We talked about debt to income ratio, back end and front end, so you kind of have an idea of what you can afford. Credit checks are standard practice for lenders before offering rates or pre-approval. Your credit report will only show one credit inquiry for every home loan application you complete within a 45-day time frame. This helps in protecting your score from being penalized more than once. Okay? So step 4, property value. You want to determine the property value. While a home survey is not really essential for a loan to be approved, it's highly recommended. The goal of the FHA loan appraisal is to determine whether or not the house is suitable for occupancy by the Housing and Urban Department, that's HUD. There are situations where when you get the home appraised, if the home is not suitable for occupancy, you can then ask the seller to make the necessary changes to make that house suitable, because that can hold up the home buying process. So you will not be able to receive FHA loan services for the house if it does not meet HUD's property requirements. So you really want to make sure, but that's something you'd have to look at once you actually know the house. A certified appraiser will not only inspect the property you want to purchase, but they will also provide an opinion on its fair market value. All right. You want to do research on that person. You want to make sure that you're getting someone who is going to be fair and appraise this for the right value. They arrive at a value based on the home's individual characteristics in the local market, as well as comparable sales in the region. Your FHA loan application will go easily if the appraised value of the house is equal to or more than the purchase price. Okay. Now, step 5, underwriting. Wait for the FHA underwriting process. The underwriter will review your application once you've chosen the home and we've done all the previous steps, credit history and income to assess the viability of your loan. Your lender may also ask extra questions throughout the FHA loan process, including they'll ask questions throughout the FHA loan underwriting process, and minor problems that the underwriter finds may need a letter of clarification and perhaps other measures on your part. As soon as the underwriter verifies that your loan satisfies all of the lender's FHA requirements, you'll be able to close. Now, this is where closing costs come into play. Pay the closure dues. Closing expenses and loan paperwork are the last step in the lending process. There may be additional charges at closing ranging from 3.5 to 6%. I recommend you have 10% of whatever the home cost is. It may not seem like it, but 3.5% down. Who knows how much closing cost is going to be? Maybe it may range from 7 to 8%. Have 10% ready. You also want to have a reserve for at least your first 3 mortgage loan payments. So to simplify all of this, whatever your home cost is, take 10% of that home cost and set it aside. If you have that, you'll probably have enough for the down payment. You'll have enough for the closing cost, and you'll also have a reserve. So that way we have a little cushion. All right, legal costs, title investigation. We know about that. Insurance fees, advance interest, real estate taxes, processing fees. We know about the standard closing cost charges. Additionally, you'll need to pay the loan origination fee, which may be negotiated down by the lender. But again, whatever the house is, to make it easy, get 10% of that, and you'll know that you have probably enough. Well, I would say, yeah, you'd have enough then at that point and some reserve to make sure that we could get this whole thing completely done. So we're wrapping it up. To sum everything up, the process for applying for an FHA loan, it can be simple. It should be simple. Lender's website and loan officers will guide you through the application procedure after you've decided which one works best for you. To ensure the application process goes as smoothly as possible, be sure to have all your financial documentation available. All right. That pretty much wraps up the FHA loan process and buying a home in 2024. And for me to wrap up and to close with the price of homes and the price and the interest rates being high, again, me personally, I've gotten pre-approved, but I decided that I would rather wait for interest rates to come down, and I would rather wait for the price of homes to drop. I don't know when that's going to happen. No one actually knows, but I know that at some point it will come up. And it will go down. And before I wrap up, I just want to show you guys one more thing. So currently I am on bankrate.com. I could also link this to the bottom for you, but I wanted to look at the 30-year fixed mortgage rates. And this one is showing 2020 to 2024. But let me take you further back. If you take a look, it goes up to 2023. We're currently in 2024, but the rates are about the same, right? 7% if you have good credit. Now, if we go back, 2022, it was 5.53%. 2021, 3.15%. 2020, 3.38%. So as you can see, there were much lower interest rates not that long ago. And if you go through the last decade, you can also see that they were relatively around that same rate. Now, we know in 2008, that was the financial crisis. They had a lot of home loans that defaulted, right, for subprime lenders. Now, if we look at that, it was around 6.23% in 2008. After that, we see a significant decrease, right? That kind of makes me aware that there may need to be a large pullback in the price of homes in order for us to start seeing those lower interest rates. So that's why, for me personally, I see that there's some type of correlation between that. So I'm estimating that when these do go down, the price of homes will go down too. So if you have you know, the same house you may pay $4,000 for now, potentially you could pay $2,000 to $2,500 for later, you know? And if we go prior to 2008, you can see they were a little bit higher rates. If we go all the way back to 1972, 7.38%, 8%, 9%, a lot higher, all the way up until we got to around that 2002 mark, up to 2009, fairly low. And then, after 2008, so on and so forth, you see what kind of caused those lower rates. Okay. So for me, I am going to be patient. I am going to wait. I want to make sure that I get the best deal possible, even if I can qualify. I like to look at history. History always repeats itself, and that allows me to know all I have to do is get in the right position. So links are in the description. I have links for credit repair, ebooks. I have links for one-on-one coachings for credit. I have links for credit builder apps that you can use, links for Identity IQ to see all three of your credit reports, and a couple of other things that you can use. I think the best thing that you could possibly do right now is put yourself in the best position for when these things change, that you are ready. Now is the time. When everything is high, when no one's looking at buying, this is the time for you to get prepared, to put yourself in the best position. So when these things do come down, when housing comes down, when interest rates come down, you'll just be sitting there ready, cash in hand, credit score looking good. You're ready. So that's what I'm going to do in the meantime. And I'll keep doing my research. I'll keep a pulse on what's going on with this market. And if you guys found value in this video, know that it took me a very long time to make. And I do appreciate you guys watching this. I appreciate your support. Please like, subscribe. Please share this with anyone. If you have any questions or if there's anything you want me to cover in addition to this, please leave it in the comments. And I will be more than happy to get back to you guys. If you made it this far in the video, thank you so much. I appreciate you for watching this all the way through. Thank you. You have a great day.